Hello, everyone. This is Ken Winans and Stephanie Larson, and we hope you're enjoying your summer as we're all getting to take our mask off now and get out and do things. But I'm sorry we haven't done a video in a while. We've been obviously very busy with things around here. I think it's safe to say it's not dull in this company, but we thought it'd be a good chance to talk, especially with unfortunately, the confirming news that inflation is still a problem and it's probably accelerating. And I know that many of you find it when you go grocery shopping or when you stay in a hotel or you go to a restaurant. I think we've all had sticker shock.
Pump gas.
Pump gas, yeah, for those of us who still have gasoline cars. But let's talk, we wanted to give you an update of some things we're doing around here. As you know, that we've been very defensive throughout much of this year, large amounts of cash on the sidelines. We've been still and continue to have very large amounts of money placed into commodity-based trades.
We still have the hedge on.
Still have the hedge on, a big part of the
Little lighter, but it's on.
We adjusted the hedge accordingly. But I did want to say this overall about the markets, and this is just, again, whether it's inflation or not. You basically have summertime volume levels drop off in the market. Markets can become very volatile, as we're seeing right now. I am of the opinion that we're probably going to continue to have volatility throughout the summer, going into the fall, a lot of it because of midterm elections. It's going to continue to play a role. The markets are very data dependent right now on housing data, government funding data, certainly earnings data that's coming out. Any company that does not hit their numbers well is going to be severely penalized.
Today was DocuSign. DocuSign missed their earnings, was down 30% today.
Yeah, no questions
just
asked.
Because.
It's a valuation play. Companies are adjusting their valuations accordingly. What I would tell you is this, that I've seen, even in the middle of major bear markets, that there are buying opportunities. Mm-hmm. I distinctly remember, sadly, after the 9/11 attacks, and that was obviously a terrible time to be in the markets, but the market, even in the middle of a bear market, did rally back up 30%. So I'm not saying it's going to guarantee that's going to happen in the fall, but we're going to be looking at the fall being an opportunity for a bottoming opportunity, and certainly other names that we would step into. Now, let me bring this up very quickly. When we think about the S&P 500, the S&P 500 are 500 companies. And I remember my mentor telling me one time, it's not a stock market, it's a market for stocks. And what we're seeing happening is that the leadership within the S&P 500 is shifting. When we hit a bottom, it is my opinion that what is going to lead this market higher is not what led the market higher in the inflation benign last 20, 30 years. We're going to find it's going to be mining companies, energy, oil and gas type companies, maybe alternative energy to some degree, food processing companies, agriculture. It is astounding. I am now looking at more old line companies that I've looked at in recent history, and you will find a lot of those old granddaddy style names in your portfolio, but that's what moves in this kind of a cycle. So don't be surprised that we will be moving and taking advantage of these things on pullbacks. And I would also just say that some of you have called and asked about the commodity situation and the commodity ETFs. You should let your accountants know that we plan to have those in the portfolio for the foreseeable future. And I know, regretfully, many of them do spit off K-1 forms during taxes. But I find if you just let your accountants know that, then they can better prepare for your taxes going into early next year. Steph, you want to add anything?
I think it'd be a really good, it'd be important to point out that if you actually look at the performance for the year, what companies, what sectors are actually performing well, it's two, and they're related. So it's commodity and energy. And so unfortunately, I mean, for some people that can be a little bit of an issue, but I mean, it's across the board. If you look at every ETF that's out there and its year-to-date performance, and then you sort it, it's going to be, the top half is all energy, all commodities, and anything that's related to that. So we are positioned well in that space. And then Ken was correct. There are still stocks that are doing well. So we are going to keep rotating the portfolios over. But it is going to look different. I mean, today was a capitulation sort of in the NASDAQ. It was down 3.5%. So tech is not going to do well in this cycle. It's just not. And there's no incentive for it to be. There's no COVID lockdown this time that's, propelling all these tech companies to do well. An interesting fact, I think that would be good for everybody to kind of know is, in the cycle of things, one of the things that turns up first is actually bonds. So the bond space has actually been really intense this year. But when I think one of the telltale signs that the bottoming is really happening is when you see the bond prices truly level off and actually start to improve. So that's actually one of the things that I'm looking at as maybe like a little sign that, okay, the market really has hit the bottom, but we are going to play the seasonality tracked with the portfolios this year as well, and hope that we get a Santa Claus rally like we did last year as well to end the year well. So.
Yeah, I just, again, you folks pay us to navigate tough waters and to try to find opportunities when we can in good waters. It's just more for anything for you, everybody to know that, we take what we do here very seriously. We do our own research. Hopefully, calmer heads can prevail. But I want to, and I know for many of you, they hear me on the ABC radio interviews out of Los Angeles. Thank you for your comments. I appreciate it. But this inflation situation is not going to go away in the near future. Inflation cycles run 6 to 8 years. My estimate, we're 2 years into it. Mm-hmm. I hope I'm wrong. I don't think I am. We are going to have to navigate an inflationary world for the foreseeable future. And that means for many of us who remember the 70s or remember other periods of time, or at least study it to some degree, realize that you have to make adjustments accordingly to strategies. And I was in Las Vegas at a conference 2 weeks ago. And I have to be honest with you, I was very caught off guard of some very big, well-known firms that manage billions. And they've been completely caught off guard by this thing. They had bonds that were coming due in 20 and 30 years. They took a beating on this. And I honestly, the only thing I can conclude is when you look at my gray beard, you can tell I've been around for a while, that a lot of these people were not around during the last time we had a crisis like this. And number two, that quite frankly, I think they honestly thought the inflation beast was dead and was never going to come back. And unfortunately it did, and they just didn't even remotely think of it possible. So the point being, we take this very serious, we're making the adjustments accordingly, and at some point we'll get an opportunity to make some money. That's what we're looking for.
Well, and I'll talk about the bonds really quick. Like I said, it's been a really intense year with the bonds. The Fed is being forced to make moves. We knew they were going to. We actually argue they should have done it sooner, and that's fine. Their decisions are going to impact everybody for a very long time, right? What's been happening is as rates are going up, the market is actually baking in what they're expecting, which is going to be higher yielding bonds. All the bonds in the market are getting pinched. The spreads are widening, so people aren't really buying. So what it's causing is prices to go down. So what we had done throughout all of last year, because we knew that inflation was coming, we were shortening the maturities of all of our bond portfolios to the best we could. You want to still get decent yield, but you really wanted to have the maturity schedule come in. Now, since the front end of our portfolios are actually pretty stacked, the 2, 3, 4 year range, what we are seeing is these incredibly inefficient bond markets and these deeply mispriced bonds. So today, what I bought was a DISH bond, and anybody that needed a bond, whether they had DISH or not, we agreed in
Okay, real quick, just so you all know, DISH is not Tupperware. We're talking about DISH, the
DISH
TV.
networks.
Yeah, I just want to make sure.
DirecTV, Comcast, Xfinity, DISH. So we've agreed in the investment committee that even if you had it, this is one of the companies that we feel comfortable with and actually doubling up a position for everybody. The DISH bond pays 6 7/8, and it's trading at a 25% discount for a 6-year bond. And I just looking at Ken going, that's insane. I don't know who wouldn't buy that. So we bought it for everybody. And so you will see a nice shiny DISH bond in your portfolio if you needed a bond show up tomorrow, Monday. So the inefficiencies of the market actually make for great buying opportunities. It's not fun to watch the prices in your portfolios go down, but since we hold the bonds to maturity, it's just price volatility. But what it's doing is giving some really interesting buying opportunities for some very, I would say, safe and financially responsible companies that I don't mind holding a bond for 6 years for them, because we're going to make, I think, almost 18% yield to maturity on it. So it's kind of a no-brainer. So it's actually exciting a little scary, but exciting, you know?
Yeah, also, just keep in mind, a lot of times, because I have people say, why are these bonds being sold or why are these stocks being sold? Remember that unfortunately, a lot of people were holding their bonds through mutual funds and exchange traded funds. So as I call the pie chart people, are shifting everything around, they're dumping, sadly, they're panicking almost in dumping their fixed income side of their portfolio, and the baby gets thrown out with the bathwater. So there's a lot of times when people talk about bonds, they use it generically, and the first thing I bring up is, what are you talking about? Are you talking about short, medium, or long-term paper?
Yeah.
There's a difference. They're very different animals.
Well, and actually, it's good to note that, it's all price volatility, right? But year to date, high yield benchmarks are down 15+%. So, and it's price volatility, but it's still a total return, right? So that's on just normal high yield paper. I'd say probably intermediate term. If you were longer, if you were one of those shops that did the barbell strategy, so you had a lot in the short and you had a lot at the end, those long bonds are down over 20-30%. That Dish bond is a 6-year bond, and it's down 25%, which makes it a great discount. Imagine if you're holding a 10, 15, 20-year bond, how much that's down. So these bond managers in the mutual funds and in ETF space, they really have gotten crushed this year. So it helps for perspective. Again, it's not fun to see price softening in your portfolio. You understand how we manage the portfolio, so it doesn't matter. The nice thing is we should get a lot of income in. It's June, so that will actually help kind of normalize the portfolios. But again, great buying opportunities, which we will actually help with our performance over the next couple of years.
Yeah. A couple of quick things. People have been asking me a lot about the dollar and also about real estate.
Yeah.
So let me just bring about the dollar. One of the blessings is, if you've had dollar-based assets throughout this mess we've been through, really since COVID, the dollar's been very strong. As rates go higher, it could actually strengthen the dollar more, which is good for us if you're worrying about dollar. If you have the dollar starting to go down and inflation would actually pick up, and you would have a situation and the economy begins to slow down, which we often think of the term stagflation. We don't want that. That is a horrible world that, for those of us that remember it in the late 70s, was awful. We don't want to go back to that. So there is strength in the dollar still, relatively speaking, and that's good. Number two, real estate. So although prices will probably maintain a fairly high level, remember that part of the price in real estate is replacement cost of the house from an inflation standpoint. I always say a house is a basket of commodities. It's cement, it's lumber, ceramic roof tiles, copper, particle board, plaster, you name it. They're commodities. They're construction materials. There's replacement cost on that. The invisible hand of economics raises houses for that automatically. But what I think you are going to see happen is that as mortgage rates normalize, and I've been trying to tell people, look, a mortgage rate between 6 and 7% is the historical average for a 30-year fixed rate mortgage. We're going to normalize. But you're going to see sales volume go down.
They did this month.
It did this month.
18%.
It did. And I think it's going to get even worse than that going forward. So just again, don't be surprised for those of you who are trying to sell houses. It might just take longer. I mean, if it's a good property and it's been all fully remodeled, meaning that people are not having to wait for materials and labor to do things, you'll find there's a buyer for it, but it's going to take time. So again, we're going through just a grand readjustment on everything, and we just have to be calm. Last word, and I know, Stephanie, you want to jump in, but let me just say this very quickly. In bear markets, the number one attribute to get through it is calmness and patience. Don't rush into things. Don't knee jerk and make bad decisions. Worst thing to do is pull out your phone and search your portfolio every day. Don't do it. Let us worry about it for you, okay? And we have a plan on how to get through this thing, but be patient and don't stare at it all the time.
No, I think that's it.
Yeah.
It covers.
So,
No, I'll chime in on what Ken just said too. I mean, we are here, we are working every single day, and we are trying to not only protect the portfolios, which you know how defensive they are, but also to really look for some opportunities, whether that's to be in different sectors that are just performing well, or to take advantage of inefficient markets on the bond side. So I know it's gonna be scary. I know today was a big day in the market down, and that can make people nervous. You know, a perfect example, because I can see how people feel about their portfolios and their money. Like, you get the emails and the calls and all of that. But a good example is, you know, money's personal. That's why everyone reacts so intensely to it. And especially if you had a hard time in 2008, for example, those memories are very vivid and real. And so you don't want to repeat that, especially as you've gone older. You know, so a good example is, you know, I drop my kids off to my parents' house. The first thing my mom says is, "Hey, the market's really down. How scared should I be?" And I'm like, "Okay, you don't have to be that scared." But I get it, and that's how I can tell that's not abnormal. That's how everyone feels. Everyone's really concerned. So we do feel that things will bottom out. We don't feel the market's going to sell off, you know, down to zero. There's definitely stocks you don't want to be in. That's for sure. And so we're minding the shop, and we take our job very seriously. So just know that we're here every day, talking, working, planning, and trying to execute and strategize.
And last thing, we are still traveling. I'm trying to get out and see clients that I haven't seen in a while. So if you haven't seen us in a while, I'm going to be down in Southern California. I'll be out in Las Vegas. I did see some people back in Florida when I was back on a brief trip. So anyway, we'd love to be able to see people face to face. I think that also helps a great deal. So just, Amy's been calling people to check in with you, make sure everything's fine. Please let her know if we can somehow get schedules to coordinate. And then final thing, Stephanie and I were just talking about it. Now that COVID is finally over, we're thinking about maybe having a Winans investment conference. It would be Zoom and also in office. So we'll float that by Amy and see if you're all interested. For those of you who remember when we did them before, we have other speakers come in and talk, whether they're reporters or people in media, other areas. So anyway, we'll get back to you on that.
Yeah, and then Ken also does a radio show every week. It's actually very interesting with Motec to listen to. We can start posting those to the portals, links to them if anyone wants to listen to them. We obviously do the videos, and I do my quarterly report. I actually spend quite a bit of time writing that. If you haven't seen that, it is in your portal under research, I think. But it's worth to read. I'll publish it the first week of the quarter. I do recommend reading it. It really does tell you everything that we're thinking and let you know. So we're trying to be very highly communicative and let you guys know what's going on, what we think, and what we're doing.
Yes, absolutely.
Okay.
So folks, have a good weekend. Just, try to enjoy that we're in this post-COVID time of not having to wear a mask, and enjoy your summer in the nice weather. And anyway, we hope to certainly hear from you, and hopefully we'll see you soon.
Yeah.
Take care.
Bye, guys.